Hi, this is Juliet, Young Orfiano. Welcome to my video. If this is your first time on my channel, please like, share, and subscribe so I can notify you if I have a new video. This is the continuation of part 20 about property, plant, and equipment. I discussed in part 20 about expenditure after initial recognition. Just click above or the link below this video to watch part 20. In this video, I am going to tackle about measurement after initial recognition. Measurement after initial recognition. An entity shall choose either cost model or the revaluation model as its accounting policy and shall apply that policy to an entire class of property, plant, and equipment. The choice of the model is to be applied to an entire class of property, plant, and equipment and not to an individual asset. A class of property, plant, and equipment is a grouping assets of a similar nature and use in an entity's operations. The following are examples of separate classes. PAR number 37, IAS number 16. A. Land. B. Land and buildings. Letter C. Machinery. Letter D. Ships. Letter E. Aircraft. Letter F. Motor vehicles. Letter G. Furniture and fixtures. Letter H. Office equipment. Cost model. A class of property, plant, and equipment shall be carried on the statement of financial position at cost, less accumulated depreciation and any accumulated impairment losses. Accounting for impairment losses is discussed in latter part of this chapter. Revaluation model. A class of property, plant, and equipment whose fair value can be measured reliably shall be carried on the statement of financial position at a revalued amount, being the fair value at the date of revaluation less any subsequent accumulated depreciation and subsequent accumulated impairment losses. Revaluation shall be made with sufficient regularity to ensure that the carrying amount does not differ materially from that which would be determined using fair value at the reporting date. The frequency of revaluations depends upon the changes in fair values of the items of property, plant, and equipment being revalued. When the fair value of revalued assets differs materially from its carrying amount, a further revaluation is required. Some items of property, plant, and equipment experience significant and volatile changes in fair value, thus necessitating annual revaluation. Such frequent revaluations are unnecessary for items with only insignificant changes in fair value. Instead, it may be necessary to revalue the item only, say, every 3 or 5 years. The item within a class of property, plant, and equipment are revalued simultaneously to avoid mixture on the statement of financial position of prices at different revaluation dates. However, a class of assets may be revalued on a rolling basis provided revaluation is completed within a short period and provided the revaluations are kept up to date. An increase in the carrying amount of the asset as a result of revaluation is credited directly to equity under the heading of revaluation surplus. However, the increase shall be recognized in profit or loss to the extent that it reverses a revaluation decrease of the same asset previously recognized in profit or loss. A decrease in the carrying amount of the asset as a result of a revaluation is recognized in profit or loss. However, the decrease shall be debited directly to equity under the heading revaluation surplus to the extent of any credit balance existing in the revaluation surplus in respect of that asset. When an item of property, plant, and equipment is revalued, any accumulated depreciation at the rate of the revaluation is treated in one of the following ways. First, restated proportionately with the change in the gross carrying amount of the asset, so that the carrying amount of the asset after revaluation equals its revalued amount proportional method. Second, eliminated against the gross carrying amount of the asset, and the asset account is restated to the revaluated amount of the asset, elimination method. The revaluation surplus included in equity may be transferred directly to retained earnings only when the asset is derecognized. Thus, over the years that the asset is being held, the revaluation surplus is left at its initial recorded amount until the asset's derecognition or subsequent revaluation. Alternatively, some of the surplus may be transferred as the asset is being used by an entity. In such a case, the amount of the surplus transferred would be the difference between depreciation based on the revalued carrying amount of the asset and depreciation based on the asset's original cost. For example, illustration, assume the following information. Case number 1. An equipment acquired on January 1st, 2005 at a cost of 2 million pesos was expected to have a useful life of 10 years. On January 1st, 2008, it was appraised to have a fair value of 1,750,000 pesos. The company carries this asset in a class that is measured using the revaluation model. On December 31st, 2009, the asset was appraised at a fair value of 900,000 pesos. On January 1st, 2012, the asset was sold for 550,000 pesos. Assume that the company follows the policy of transferring some of the surplus as the asset is being used. Proportional method, January 1st, 2008 computations. Fair value or revalued amount, 1,750,000 pesos. Carrying value at 1/1/8. 2 million times 7/10 is 1,400,000 pesos. Revaluation surplus is 350,000 pesos. 2008 January 1st, debit equipment for 500,000 pesos, credit accumulated depreciation for 150,000 pesos, credit revaluation surplus for 350,000 pesos. The increase in the carrying value of the asset is 350,000 pesos, which is equivalent to 25% of the previous carrying value, or 350,000 over 1,400,000 pesos. Thus, the asset account is increased by 25% times 2 million or 500,000 pesos, and related accumulated depreciation is similarly increased by 25% times 600,000 pesos or 150,000 pesos. After the revaluation, the equipment's carrying value is equal to its sound or fair value, 2,500,000 less 750,000 or 1,750,000 pesos. The computations may be summarized as follows. Gross cost is 2 million. Appraisal is 2,500,000 pesos. Increase 500,000 pesos. Accumulated depreciation cost 600,000 pesos. Appraisal 750,000 pesos. Increase 150,000 pesos. Net cost is 1,400,000 pesos. Appraisal 1,750,000 pesos. Increase 350,000 pesos. 2008 December 31st, debit depreciation expense 250,000 pesos. Credit accumulated depreciation 250,000 pesos. 1,750,000 pesos divided by 7 years. December 31st, debit revaluation surplus 50,000 pesos. Credit retained earnings 50,000 pesos. 350,000 pesos divided by 7 years. The depreciation entry is followed by an entity transferring a portion of the revaluation surplus retained earnings. On December 31st, 2009, after recording the depreciation for the year and transferring 50,000 pesos of revaluation surplus to retained earnings, the company prepares the following entry to reflect the second revaluation. 2009, December 31st, debit accumulated depreciation 350,000 pesos, debit revaluation surplus 250,000 pesos, debit impairment loss or revaluation loss 100,000 pesos, credit equipment 700,000 pesos. Gross appraised CV 2,500,000 pesos, appraisal 1,800,000 pesos, decrease 700,000 pesos. Accumulated depreciation, appraised CV 1,250,000 pesos, appraisal 900,000 pesos, decrease is 350,000 pesos. Net appraised CV 1,250,000 pesos, appraisal 900,000 pesos, decrease is 350,000 pesos. The decrease in fair value of 350,000 pesos, 1,250,000 pesos less 900,000 pesos, represents 28% of 1,250,000 pesos. Thus, the gross asset account and accumulated depreciation are correspondingly decreased by 28%. 28% of 2,500,000 pesos or 700,000 pesos and 28% of 1,250,000 pesos or 350,000 pesos. The net decrease in the asset account is charged first to the revaluation surplus to the extent of its balance of 250,000 pesos, which is the unrealized amount of revaluation surplus, and the remainder is charged to impairment loss or revaluation loss. The loss account is represented in the statement of comprehensive income as part of operating expenses. Net decrease in the value of equipment 350,000 pesos, balance of revaluation surplus 350,000 pesos less 50,000 pesos less 50,000 pesos is 250,000 pesos. Revaluation loss is 100,000 pesos. The revalued amount of 900,000 pesos shall be depreciated over the remaining useful life of 5 years. Thus, annual depreciation is revised to 180,000 pesos starting with the year until the subsequent revaluation. The revaluation surplus account has already been brought to zero balance, so no amount shall be transferred to the retained earnings account. 2010, December 31st, debit depreciation expense 180,000 pesos, credit accumulated depreciation 180,000 pesos, 900,000 pesos over 5 years. 2011, December 31st, debit depreciation expense for 180,000 pesos, credit accumulated depreciation for 180,000 pesos. After the last entry, the balances are as follows. Equipment 1,800,000 pesos, accumulated depreciation 900,000 pesos plus 180,000 pesos plus 180,000 pesos is 1,260,000 pesos. The carrying value is 540,000 pesos. On January 1st, 2012, When the equipment is sold, a gain of 10,000 pesos is recognized for the excess of the selling price of 550,000 pesos over its carrying value of 540,000 pesos. The sale of the equipment is recorded as follows: 2012, January 1st, debit cash for 550,000 pesos, debit accumulated depreciation 1,260,000 pesos, credit equipment 1,800,000 pesos, credit gain on sale of equipment 10,000 pesos. Elimination method. Using the same information, if the accumulated depreciation is eliminated against the gross carrying amount of the asset, journal entries from January 1st, 2008 through January 1st, 2012 are: 2008 January 1st, debit accumulated depreciation 600,000 pesos, credit equipment 250,000 pesos, credit revaluation surplus 350,000 pesos. The journal entry eliminated the accumulated depreciation balance and at the same time reduced the equipment account balance by 250,000 pesos, leaving a balance of 1,750,000 or 2 million less 250,000, which is equal to its fair value at the date of revaluation. December 31st, debit depreciation expense for 250,000 pesos, credit accumulated depreciation for 250,000 pesos. 1,750,000 pesos over 7 years. December 31st, debit revaluation surplus for 50,000 pesos, credit retained earnings for 50,000 pesos. 350,000 pesos over 7 years. 2009 December 31st, debit depreciation expense 250,000 pesos, credit accumulated depreciation 250,000 pesos. 2009 December 31st, debit revaluation surplus 50,000 pesos, credit accumulated depreciation 50,000 pesos. 2009 December 31st, debit accumulated depreciation 500,000 pesos, debit revaluation surplus 250,000 pesos, debit impairment loss or revaluation loss 100,000 pesos, credit equipment 850,000 pesos. Gross amount appraised CV 1,750,000 pesos, appraisal 900,000 pesos, decrease 850,000 pesos. Accumulated depreciation appraised CV 500,000 pesos, decrease 500,000 pesos. Net appraised CV 1,250,000 pesos, appraisal 900,000 pesos, decrease 350,000 pesos. The journal entry eliminated the accumulated depreciation balance and at the same time reduced the equipment account balance by 850,000, leaving a balance of 900,000 pesos. 1,750,000 less 850,000 pesos, which is equal to its fair value. Similar to the proportional method, the decrease in the value of the equipment of 350,000 pesos is charged to the revaluation surplus to the extent of its balance of 250,000 pesos, and the remainder is debited to revaluation loss of 100,000 pesos. On 2010, December 31st, debit depreciation expense for 180,000 pesos, credit accumulated depreciation 180,000 pesos, 900,000 pesos over 5 years. 2011, December 31st, debit depreciation expense 180,000 pesos, credit accumulated depreciation 180,000 pesos. On January 1st, 2012, the ledger balance shall show carrying value for the equipment of 540,000 pesos, computed as follows. Equipment 900,000 pesos, accumulated depreciation 360,000 pesos. The carrying value is 540,000 pesos. The sale of the equipment would then result to the recognition of gain amounting to 10,000 pesos. 2012, January 1st, debit cash for 550,000 pesos, debit accumulated depreciation for 360,000 pesos, credit equipment for 900,000 pesos, credit gain on sale of equipment 10,000 pesos. Case number 2. An equipment acquired on January 1st, 2005 at a cost of 2 million pesos was expected to have a useful life of 10 years. On January 1st, 2008, it was revalued at a fair value of 1,750,000 pesos. On December 31st, 2009, the asset was revalued at a fair value of 900,000 pesos. On January 1st, 2012, the asset was sold for 550,000 pesos. Assume that the company follows the policy of transferring the whole of the surplus when the asset is retired or disposed of. Assume further that accumulated depreciation is restated proportionately upon revaluation. The journal entries are as follows. 2008, January 1st, debit equipment, 500,000 pesos, credit accumulated depreciation, 150,000 pesos, credit revaluation surplus, 350,000 pesos. December 31st, debit depreciation expense, 250,000 pesos, credit accumulated depreciation, 250,000 pesos, 1,750,000 over 7 years. 2009, December 31st, debit depreciation expense, 250,000 pesos, credit accumulated depreciation, 250,000 pesos, 1,750,000 over 7 years. December 31st, debit accumulated depreciation, 350,000 pesos, debit revaluation surplus, 350,000 pesos, debit impairment loss or revaluation loss, 100,000 pesos, credit retained earnings, 100,000 pesos, credit equipment, 700,000 pesos. The credit to retained earnings account is for the amount of the revaluation surplus that has not been transferred to the retained earnings during the years 2008 and 2009 as computed as follows. Depreciation based on cost for years 2008 and 2009. 1,400,000 over 7 times 2 years is 400,000 pesos. Depreciation based on revalued amount, 1,750,000 over 7 times 2 years, 500,000 pesos. Difference, realized revaluation surplus is 100,000 pesos. 2010, December 31st, debit depreciation expense for 180,000 pesos, credit accumulated depreciation 180,000 pesos, 900,000 pesos over 5 years. 2011, December 31st, debit depreciation expense 180,000 pesos, credit accumulated depreciation 180,000 pesos. 2012, January 1st, debit cash 550,000 pesos, debit accumulated depreciation 1,260,000 pesos, credit equipment 1,800,000 pesos, credit gain on sale of equipment 10,000 pesos. Thank you for watching my video. I hope you learned something from this video. I did part 22 and continuation of this video wherein I discuss in part 22 about the impairment of asset values. Just click above or the link below this video to watch part 22. Don't forget to like, share, and subscribe on my channel so I can notify you if I have a new video. Once again, this is Juliet Orfiano. See you on my next video.